Hello and welcome to another video where today I will be taking you through a financial accounting preparing financial statements mock exam. So this is mock 2 from the AAT website. So I'll take you through task by task. It will be in two parts as well. So obviously watch both parts unless you just want to watch half an exam. That's fair enough if that's what you want to do. And remember, if you do enjoy the video, do me a huge favor and hit that like button, subscribe to the channel and go and follow me on Instagram for more accounting tips. But anyway, let's swap over to the exam and make a start. Right then, so the Financial Accounting Preparing Financial Statements exam is a 2.5 hour exam, which involves 6 tasks and is worth 120 marks. So part 1 of this video will cover tasks 1 through to 3, and part 2 will cover 4 through to 6. Obviously, if you do have any questions, please do drop them in the comments below, and I will pick them up as quickly as possible. Right then, let's make a start with task 1. So task 1 is worth 28 marks and is about using daybooks and accounting for and monitoring non-current assets. This task contains parts A and B. Part A then is worth 3 marks. Identify whether the following statements are true or false. So we'll look at each statement and we'll determine why it's either true or false and the reason. So statement 1, an advantage of using a book of prime entry in a manual system is that all errors will be eliminated. Now, a book of prime entry does definitely help with error checking. However, in this statement, it does say that all errors will be eliminated. And unfortunately, using a book of prime entry wouldn't eliminate every error. It would just help eliminate some errors. Because the book of prime entry will be checked before being totaled and then the figures entered into the general ledger, it is a point in which to check errors. However, that doesn't mean you would eliminate all errors. So that one would be false. An advantage of using a book of prime entry in a manual system is that transactions are summarized prior to being entered into the general ledger. Well, that is definitely true. So within your book of prime entry, you would enter in all the transactions for that day or week or month, although month may be a little bit extreme. And what you would then do is you would total those figures and then take those totals and enter them into your general ledger. So that would be absolutely true. That would be the process. And then the last statement, one purpose of the non-current asset register is to assist in physical verification of assets. Well, that would be absolutely true. It's a job that I have actually done in the past, and we basically printed out a listing from the asset register, and I had to go, as anyone would do if you're doing a physical check, and you're basically cross-checking what is on your non-current asset register with what you physically have in your warehouse or wherever it is that you keep your inventory. So that would be absolutely true. Moving on then, it is important for the part of the business wishing to purchase high value non-current assets to obtain authorization. Identify which of the following is not a reason for this. So the reasons are, and this is only for 1 mark, that managers can ensure that funding is in place for the expenditure, but that would be a reason, so it's definitely not that one. Managers would need to make sure that there's some sort of funding in place, because usually capital expenditure is quite expensive. Next option, that managers can ensure that the spending fits in with the long-term plans of the business. Again, that would also be true. Again, because capital expenditure is quite expensive and there's usually some sort of long-term gain, because that's why it's a non-current asset, there would be some economic benefit to the business. You would have to make sure as a manager that that aligns with the business's plans. So that would be a reason. So let's hope it's number 3. If not, then something's gone madly wrong here. So the last option, to comply with accounting regulations, it definitely doesn't form part of official accounting regulations. Now, I'm not saying if you had an audit, for example, and I don't want to go too off topic here, but if you had an audit, they would probably want to see some sort of authorization. However, that doesn't mean that it needs to be done in order to comply with accounting regulations. So in terms of the reason, it would be number 3. Right, next on the list, complete the following statement regarding depreciation of non-current assets. The depreciable amount of an asset is the cost of, and then we have 3 options. So it's either the cost of the asset less accumulated depreciation, or the asset less the residual value. So the correct answer here would be the asset less residual value. So when we're depreciating an asset, we're looking at the likely loss of value over the ownership, or what we would class as the useful life of that asset. Now, if there is a residual value, this would be the amount that we expect it still to be valued at, i.e. we could sell it on for X amount at the end of its useful life. So if we took a car, for example, it may be that you bought it for 20,000 and after 5 years, you expect it to be worth 5,000. Now, if you expect it to still be worth 5,000, you don't want to depreciate that amount because it still has worth, it still has value. So the depreciable amount would be the amount between the cost and the residual value. So the correct answer would be the asset less residual value. Moving on then, so Nancy Jones is a sole trader. She keeps a non-current asset register which is separate from the ledgers. VAT can be ignored. You are working on her accounts for the year ended the 31st of March 2018. Nancy has the following policies in place. Relevant expenditure over £150 is to be capitalised. Okay, so quite a low value, but that's fair enough. We go with the rules, we go what's given in the question. A full year's depreciation is to be charged in the year of acquisition. No depreciation is to be charged in the year of disposal. So what we're saying there, full year is to be charged in the year that the asset was purchased, irrelevant of when it was bought in the year, but when the asset is sold, we won't be charging any depreciation within the year of disposal. Machinery is to be depreciated at 20% using the straight line method. It is to be assumed that there is a 5% residual value. Vehicles are to be depreciated at 25% using the diminishing balance method. There is expected to be no residual value. Okay then, so on the 28th of February, Nancy sells a van, TA54 VLC. She receives £5,000 as a bank transfer. This van was purchased on the 11th of March 2016 for £27,000. On the 1st of March 2018, Nancy receives an invoice for a machine. I'm pronouncing that as tool. That's what we're going with anyway. And an extract of which is shown below. And we've got an invoice extract with various information, which I am sure we will need when it comes to later down within this question. James, who works for Nancy, is paid £25 per hour, and it took him 15 hours to install and set up the machine. Part B then, enter this acquisition and the disposal into the non-current asset register shown below. Enter the depreciation entries into the non-current asset register shown below, and then all figures should be shown to 2 decimal places, entering in any dates in the format, and we've got day, month, year. So show the years as X6, X7, X8, just allows them to reuse the question without having to constantly change dates, if anyone's ever wondered why they do that. So, and if your answer is 0, then enter 0.00. And below we have a non-current asset register. So what we need to do is basically take the information both up here and what's already in there and fill out the empty boxes. So usually quite a straightforward question, this one. The important thing where I see people go wrong is purely rushing, because it's quite an easy question. Once you've done quite a few, people tend to fly through these, and it is important that we just take into account all the information that's being given, because it is easy to make a mistake. So the first one that we have on the list is for machinery, and let's just remind ourselves how machinery was depreciated. So it says it's depreciated at 20% using the straight line method, and it is to be assumed that there is a 5% residual value. So what's really important here is this machine, this SHRS 1000, it hasn't been sold. So we can assume, because it's on the straight line, that the depreciation amount will be the same every single year. And because nowhere in the question it talks about proportioning depreciation on a monthly basis, we can safely assume, as I said, that the depreciation charge for the year will be the exact same as what it has been for the previous 2 years. Obviously, that would be different if we'd sold an asset, which I'm sure we will be coming on to very shortly within this question. So we can safely assume that the depreciation charge for the year will be 1,843. And the carrying amount, in fact, let's just make sure as well we follow the same format as what's being shown. So we'll do 0.00. And the carrying amount would be the net book value at the end of the 31st of March 2017, less the depreciation that we've charged within this year. So it would be 6,014 less 1,843, giving you a carrying amount of 4,171. Again, let's follow the same format as what's been done so far. It does specifically state in the question, all figures should be shown to 2 decimal places. Okay, so next on the list is our acquisition. So this is for, again, we're gonna go with tool. Please feel free to correct me in the comments if I'm wrong. So what information do we have? So this is our invoice. So what we need to do is determine what can be included when capitalizing the item. So I think fairly obviously, and one that we could all agree on straight away, is the 12,000 for the actual machine itself. Now we can also include delivery on that of £100. So we'd add those two together. However, we cannot include the maintenance contract because that would be an ongoing expense. It's not actually adding to the value of the asset or included within the setup costs of getting the asset to a usable condition. So the £200 would go as revenue expenditure. It would go to our profit or loss account. However, what we also have is another piece of information at the bottom where it says James. I'll just use my mouse here to highlight it. So James, who works for Nancy, is paid £25 per hour, and it took him 15 hours to install and set up the machine. Because this is classed as setup costs, we would be allowed to include those costs within the overall capital expenditure for this particular item. So what we would do is we would add up the cost of James setting that up. So it would be £25 per hour times 15 hours, which comes to £375. And we would add that to the 12,000 and the 100 delivery to give us a total capital cost for this particular asset of 12,475. So we can enter that in, again to 2 decimal places. Now we also need to work out the depreciation charge because it says, if we remember, that machine is to be depreciated 20% using the straight line method, and there's going to be a 5% residual value, so we'll take that into account. But it says that a full year's depreciation is to be charged in the year of acquisition. So what we need to do to calculate the depreciation on this particular item is first work out the residual value, which it says it's assumed for machinery that it will be 5%. So what we need to do is take 5% of the overall acquisition cost. So it would be 12,475 multiplied by 5%, which gives us £623.75. So what we need to do is take that off before we calculate our depreciation figure, because we don't want to be depreciating the residual value. So it would be 12,475 minus £623.75, which leaves us with a depreciable amount of £11,851.25. And it states that we depreciate this at 20%. So we would do 20% of this depreciable amount, which gives us a depreciation figure of £2,370.25. So let's enter that in. So then the carrying amount is calculated as the acquisition cost. This is for year one, by the way. So the acquisition cost less the depreciation charge, which gives us a carrying amount of £10,104.75. We can now move on to our vehicles. So this first vehicle, TA54 VLC, was the vehicle that we disposed of. So let's have a look at those details. So it says on the 28th of February, Nancy sells the van and she receives £5,000 as a bank transfer. The van was purchased on the 11th of March for £27,000. Okay, so what's super important within this is this line here, because it states that no depreciation is to be charged in the year of disposal. So what that would mean is in our depreciation charge, it would be 0.00, because it's stated that everything needs to be to 2 decimal places. The carrying amount would also be 0.00. The reason being, you've sold that asset at this point. So why would you want to show a carrying amount in your non-current asset register if you no longer even own that vehicle? It would mean that your accounts are just plain wrong. So we need to show that as 0. And the disposals proceeds, it's stated, were £5,000. And the disposal date, let's just scroll up to remind ourselves, it states was the 28th of February 2008. So we'd go 2802X8. So again, follow the format that it asks you to do these in. Now the last asset on the list is another vehicle, and it's TR08HNE. So these, remember, are depreciated on a diminishing balance method, and they are done at 25% per year. So remember, when you're doing diminishing balance, it wants to be 25% of the net book value. And the net book value is the cost less accumulated depreciation. So it's actually given as the net book value anyway, because net book value and carrying amount are the exact same thing, interchangeable names. So what we would do is, to calculate the depreciation for this year, we would do 14,700 multiplied by 25%. And that gives us a depreciation charge for the year of 3,675. And then to get your carrying amount, all you do is, again, your net book value or carrying amount from the previous year less your depreciation, which would give us a new carrying amount at the end of this year of 11,025. So that completes the non-current asset register. We'll now move on, and it looks like we're going to be doing a T account for disposals here. So complete the disposals account for the disposal of the vehicle, showing the amount to be transferred to the statement of profit or loss. All figures should be shown to 2 decimal places. So I'm not going to go into a huge amount of detail on how to do disposals, because I have a full video specifically designated to both this. I actually have another one specifically covering the non-current asset register as well. So if they are areas that you're not sure on, be sure to check those videos out as well. But let's have a look at how to do this disposals T account then. So there is an order in which I do these, and it starts off by clearing the cost of the asset first. So the vehicle that we disposed of was TA54 VLC. So the original cost was for £27,000. So to remove that, we would credit the vehicle at cost account and debit the disposals for the full cost, which would be £27,000. Again, it says show to 2 decimal places, so we put 0.00 on the end. I would then remove the accumulated depreciation. This would always be step 2 for me. And to do that, remember the entries are to debit accumulated depreciation, clearing it out, and credit the disposals account. So it would be accumulated depreciation. Scroll down. And then the value of your accumulated depreciation. To get that, we just need to add up the depreciation from our non-current asset register, which comes to £11,812.50. The next thing I would do is always put the amount that was actually received, which would go to your bank, unless it's part exchange, in which case it would go towards the new asset. But in this case, it goes to a bank. So that would be for 5,000. And then your difference between the two sides is going to be either a profit or a loss. Now, what we're saying here is in our accounts, this vehicle was valued at £27,000 less £11,812.50, i.e. the net book value, we've actually got it up here, was £15,187.50. But we sold it for £5,000, so we actually made quite a significant loss on this. Now, the difference between the two sides is going to be your amount. So if we do the balance between your debit side and your credit side, that comes to £10,187.50. And that will always go in on the lower side of the account, and it will go to your P&L. So statement of profit or loss. Enter that in and you'll see that both sides should balance. If they don't, you've done something wrong. Okay, they have to balance. The disposals is always a holding account, so there will never be a balance in your disposals account. It should always match off because the balancing figure will go to the statement of profit or loss. So if they don't equal in your exam, have a look back through because something has gone wrong. Right then, the last task, complete the journal for the depreciation charge for all of the machinery for the year ended the 31st of March 2018. Show your answer to 2 decimal places. So if we look up at our non-current asset register, we depreciated both pieces of machinery that we have in here. So what we would need to do is first add those up to get the total depreciation for machinery. So if we add those two up, which is your 1,843 and your £2,370.25. That comes to a total depreciation amount of £4,213.25. So we can enter in the amount. So the double entry for recording your depreciation charge will always be the same, and that will be to debit the depreciation expense and credit your accumulated depreciation. So select your 2 accounts and then it will be debit and credit. And that wraps up task 1. So hopefully nothing too difficult in there. I know the disposals account can be a little bit tricky, but once you've done a few, they are relatively straightforward. So what we'll do now is we'll move on to task 2. Right then, task 2 then is worth 14 marks and is about recording period end adjustments. And this task contains parts A through to C. You work at an accounting practice working on several different client accounts. Your manager approaches you and tells you she needs the prepaid expenses finalised before the end of today for a specific client. If that is not possible, then you should just leave them out completely. Part A then. Identify which one of the following is a potential consequence of complying with your manager's request. And it's worth 1 mark. So we need to select from the following options. So the accounts will give a true and fair view of the state of the organisation, but it's definitely not going to be that one. If you've missed out your prepayment adjustments, then it wouldn't give a true or fair view. Statement number 2, profit will be understated and liabilities will be overstated, leading to the incorrect decisions being made. Profit will be understated and assets will be understated, leading to an incorrect decision being made. And then we've got profits will be overstated and liabilities will be overstated, leading to incorrect decisions being made. and profit will be overstated and assets will be understated, leading to incorrect decisions being made. So it's one of these four. And I think the best way to get rid of two straight away is think about what a prepayment actually is. Is it an asset or is it a liability? Well, a prepayment is something where we've paid for goods or services upfront, but we've not yet had them. So effectively what we have is a receivable to the business because we are owed some goods or services, whichever that may be. Both would still be classed as prepayments. So it's classified as an asset to the business. So that leaves us with option 3 and option 5. So all we need to do now is determine whether the profit will be understated or the profit will be overstated as a consequence of not adjusting for these prepayments. So the next part then, we need to think about how does a prepayment actually affect our expenses? Well, when we're prepaying something or when we're adjusting for a prepayment, what we're doing is we're removing it out of the expenses for the current year and entering it in within the next year, or the next period would be more technically correct, but for AAT they tend to just do it between years. Now, with that in mind, what you're then doing is reducing your current expense and increasing your expenses within the next period. So we now need to think, what effect will that have on profits? Well, if those expenses have not been taken out to be put into the next year, that means your expenses for the current year you're working on or current period that you're working on will be too high. Now, if your expenses are too high because they've been overstated, that would make your profit too low because you're taking your expenses from your income to calculate your profit. So if your expenses are too high, that's going to mean that your profit is too low. So it would be that profit will be understated and assets will be understated, leading to incorrect decisions being made. The effect of actually adjusting for those prepayments would lower our expenses, increasing our profit, and the other entry, the other part of the double entry, would go to our assets under the account prepaid expenses. So that covers part 1 of A. The next part then. The financial year ends on the 30th of June 2000 and we'll go with 18. Complete the following statements. And again, this is for 1 mark. Any adjustments for prepaid expenses that are made should be dated, and we need to select from our calendar the correct date. So any adjustments would need to be made at the period end, so on the 30th of June. So if we just go back 1 and we'd select the 30th of June. And then the next part, the reversal of these adjustments for prepaid expenses should be dated the first date of the following period. So you would remove them from the period that you're working on, and then they would be re-entered in the period that they actually relate to. So for this example, that would be the 1st of July. Brilliant, no issues there. Let's keep going. You receive an email from another client including the following. The invoice we sent to JS Limited, one of our customers, should be paid at the start of the next financial year, but I have a feeling that they might not be able to pay. So part 3, identify the course of action that you should take. So we've got 4 different options. We can either write off the debt as irrecoverable, we can set up a specific allowance for doubtful receivables, we could do nothing until next year, or we could take the amount out of the general allowance for doubtful receivables. So we can get rid of 2 options straight away. We can get rid of write off the debt as irrecoverable because we don't know that as such. There would be further criteria that need to be met in order to write this off as irrecoverable. So it's definitely not going to be that one. And we don't want to do nothing either. So we really have 2 options left. We can either set up a specific allowance for doubtful receivables, or take the amount out of the general allowance for doubtful receivables. Now, because this relates to a specific customer, what we would want to do is set up a specific allowance for doubtful receivable against this particular transaction. We would then add that to our general allowance to get our total allowance for doubtful receivables amount. Brilliant. Okay, let's keep going. You are now working on the accounts of Angela Deering, a sole trader for the year ended the 30th of June. You are considering the administration expenses account. The cash book figure is £35,750. This includes £800 electricity, which was related to May and June 2000, and we'll go with 17. And an adjustment relating to this was made in the year ended the 30th of June 2017, but the corresponding entry has yet to be made in the current year. An invoice for insurance has been included for £4,500 regarding the 12 months from the 1st of February 2018. Part B then, complete the administrative expenses account for the year ended the 30th of June 2018, ensuring it is balanced off appropriately. Enter your answers to 2 decimal places, and this is worth 7 marks. So when it comes to answering these, dates will be absolutely essential, so please make sure you watch very carefully for all the dates that are given. Now, probably the most important date, you could argue, is the year-end date, because this will affect every other transaction. So the first part that we need to take into account is this £800 electricity, which was related to May and June 2017. And an adjustment relating to this was made in the year ended the 30th of June 2017. But the corresponding entry has yet to be made in the current year. So this is an adjustment that related to the previous year, but would have been reversed within the current year we're now working on. Now, this would relate to an accrual. And the reason why we know it would relate to an accrual is because if we were adjusting for May and June in the previous year, we would have to be adding those amounts in. There would be absolutely no reason to adjust for a prepayment given that those months related to the previous year. So there'd be absolutely no reason, as I said, to actually enter in a prepayment when those months relate to the year that you were working on. So it has to be an accrual. So what they're effectively saying is we had an £800 accrual that we'd not had the invoice for, and therefore we had to include for May and June of last year. However, what would happen is at the start of the year you're currently working on, they would have been reversed. Now, the entries in the previous year, so what would have been entered in at the end of the prior year, would have been to add those into your expense. So to add those into the expense, it would have been to debit the administrative expenses account with £800. However, we're now working at the start of the current year that we're on, so the end of 2018. So we would need to reverse that transaction at the start of the year. So if we debited it at the end of the previous year, to reverse that, we would need to credit it within the current year. So what we would do, we would select accrued expenses reversal, and that would be for £800. Again, it wants us to enter these to 2 decimal places. So next on the list is the cash book figure of £35,750. So this is what's been paid out throughout the year relating to administrative expenses. So we can enter that in. So that would be cash book, and then it'd be 35,750.00. Now, the next point that we need to take care of, it says an invoice for insurance has been included for £4,500 regarding the 12 months from the 1st of February 2018. So for here, we would be looking at a prepayment. So this is going to cover from the 1st of February 2018 through to the end of January, because it's 12 months, 2019. But the year end we're working on is up to the 30th of June 2018. Therefore, we have an amount of this invoice that relates to the following year and therefore needs to be adjusted for using a prepayment. So the first thing to do is determine how much of this £4,500 relates to the following financial year. So if this covers from the 1st of February through to the end of January, think about the months that relate to the year we're working on. So it's going to be February, March, April, May, and June, which is 5 months. So 5 months of this 4,500 relates to the current year. The remaining amount, so 7 months, relates to the following financial year. So what we would do to get our prepayment amount is do 4,500 divided by 12 to get the monthly amount, and then multiplied by 7. Okay, remember the prepayment is related to the amount that we are adjusting for, that we are moving into the following year. So that works out to be 2,625. So what we would do is we would credit our administrative expenses account and we would debit our prepaid expenses account. So let's do that now. So by doing that, we would have successfully moved the 2,625 out of this year's administrative expenses account, and in the following period, so at the start of the next financial year, that would reverse and that would fall into the correct period. So the last thing we need to do here is close this account off by transferring the balance to the profit or loss. So to do that, we would add up our debits, add up our credits, and do the difference between the two, and that would be the amount that would go to our profit or loss account. So if we do the difference between the two now, that works out to be 32,325. So that needs to go to our statement of profit or loss. So that will be 32,325.00. And you should see at the bottom that these two totals balance. If not, then something has gone wrong. The whole idea of transferring to the statement of profit or loss is that it clears out that account ready to start afresh from the next financial year. Right, moving on to the next task then. Your final task for the day is to work on the final accounts for AJ, a sole trader who runs a sweet shop. Alongside the sweets, he sells hand-decorated sweet jars. He's considering his inventory of sweets. It is his policy to sell any sweets which he does not consider perfect at 50% of their normal selling price. One of his range is AR sweets. Each packet of sweets retails for £2.50. They cost £1.75 per packet to manufacture. He currently has 87 packets of these sweets. A box containing 15 packets of sweets was dropped and all packets were damaged. Part C then, what is the total inventory value which should be included in the accounts with regards to AR sweets? Show your answer to the nearest penny, and this is worth 2 marks. So the key consideration or key accounting concept that we need to work to here is IAS 2, which is inventories, and that states that inventory should be valued at the lower of cost, i.e. what the product cost, or the net realizable value, which is what you can sell it for less any costs in order to be able to sell it, or anything that you would have to pay to fix that product in order to be able to sell it. So in this example, we have 87 packets of sweets, and we have 15 of those which are damaged. And it states that AJ sells these at 50% of their normal selling price. So their normal selling price is £2.50. So if he's only selling them for 50% of their normal price, that would mean that he's selling them for £1.25, because that's 50% of £2.50, which means that the selling price is actually lower than the cost. So when it comes to valuing these, what we're going to do is we're going to value 15 of them at £1.25 and the remaining at their cost amount of £1.75. That would mean that we have 15 times £1.25 and the remaining 72 multiplied by £1.75, and if we add the two together, that gives us £144.75. Right then, the very last question. The jars retail for £20 each and cost £10 each. 3 jars are damaged and will cost £40 to repair. They will then be offered for sale at a 10% discount. What is the total inventory value which should be included in the accounts with regard to these 3 jars? Show your answer to the nearest penny. So remember, we need to value these at the lower of cost and net realizable value. So the cost in this example is £10 for each of the 3 jars. So in total, the cost for all 3 jars would work out to being £30. Now let's calculate the net realizable value and see whether this is lower or higher than that cost. So we've got 3 jars at £20 each, which would be £60. However, it's saying that they will be offered at a sale of 10% discount. So 10% of 60 would be 6. So we take the £6 off the selling price of 60. So that would give us £54. However, it also states that the 3 jars are damaged and it will cost £40 to repair. So we then have to take off a further £40. So £54 minus a further 40 to get these jars into a sellable condition would give you a net realisable value of £14. So as £14 is lower than the cost of 30 for all 3 jars, then the total inventory value would be £14. So let's enter that in. So it'd be 14. And that completes task 2. We'll now move on to task 3. Right then, task 3 is for 24 marks and is about producing, adjusting, checking and extending the trial balance. So I think it's fair to say that this task is firmly based around the extended trial balance. This task contains parts A through to D. Part A then, identify whether the following statements about extended trial balances are true or false, and it's worth 4 marks. The first statement then, an extended trial balance for a partnership will have extra columns for the appropriation account. So this would be false. Not a huge deal of explanation here other than it doesn't. There are additional items that would be included within the extended trial balance for a partnership. However, there wouldn't be additional columns related to the appropriation account. So that one would be false. Interest on drawings may appear on a partnership extended trial balance but will not appear on a sole trader trial balance. That is absolutely true. So for a sole trader, there is no interest on drawings. It's only related to a partnership. So that would be true. Statement 3. A partner's salary will appear as a debit in the statement of profit or loss columns of the ETB and a credit in the statement of financial position columns of the ETB. So this one would also be true. So a partner's salary is shown in the debit side of the statement of profit or loss. It's not an expense to the business, but it does work in the same way. It takes away from profit. And it's a credit in the statement of financial position because it is owed to that individual partner until they physically take it out. So that would be true. And then the last statement, a capital account may appear on a sole trader extended trial balance but will not appear on a partnership trial balance. Well, that would definitely be false. The capital accounts do appear on the extended trial balance of a partnership. There would just be multiple. Because you've got multiple partners, there would be multiple capital accounts related to each partner. All right, fairly straightforward. Let's move on. Jacob runs JS Supplies, which is not VAT registered. State the overall effect on the elements of the accounting equation for each of these transactions. So it looks like here we've got 2 statements and we need to determine whether it will affect assets, liabilities or capital and whether they will be, I'm guessing, an increase, decrease or no effect. So I think firstly let's just remind ourselves what the accounting equation is, and it would be assets minus liabilities equals capital. So the first statement then, JS Supplies, obtain a loan from a bank. So the effect of getting a loan from a bank would firstly increase your bank balance because we're getting the money in from the loan. So that would increase our assets. However, a loan is obviously something that the business would owe, and therefore that would also increase our liabilities. Now, because it's assets minus liabilities equals capital, by increasing both, presumably by the same amount, that would mean that the effect on capital is nothing. So that would be no effect. And then the next statement, JS Supplies makes purchases on credit. So think about again, the effect of buying something on credit. Would it affect our assets? Absolutely not, because we've not paid for it yet. So it wouldn't affect our bank. It would, however, affect our liabilities, because by buying something on credit, you're increasing the amount owed to your suppliers. So your trade payables would increase. So our assets, there would be no effect. Our liabilities would increase, which means because there's no effect on assets, but there's been an increase to our liabilities, and the accounting equation being assets minus liabilities, that would mean, because our liabilities are higher, that our capital would decrease. Excellent, right. Okay, next question. You are reconciling the balance on the payables ledger control account to the sum of the balances on the individual accounts within the payables ledger. The payables ledger control account balance is 27,446, and the sum of the balance on the individual payables accounts is 27,214. Following an investigation, a number of errors have been discovered. Part B then, identify the entries which need to be made in the relevant accounts to correct any errors that may have caused the difference between the two balances. Each error should have at least one entry next to it. If there is no overall effect, select no effect in the last column. Right then, so let's work through each of these and see whether it affects the payables ledger control account or the individual's payables account, and then determine whether it's a debit or a credit or whether it has no effect. So the first one, an invoice from John Green for £140.70, including VAT, has been posted to Jan Grun's account in the payables ledger. So what we need to think about here is, will the effect of this transaction have caused the payables ledger control or the individual's payable account to increase or decrease? Now, if that causes a disparity between the two, i.e. would make one higher or lower, then we've got a problem and we need to correct it. Now, if it doesn't, that's not saying that the accounts are correct, but it would have no effect on the difference between the two. So this first one is a great example. You see, what it's saying here is it's not being included on the wrong side of the account. It's not being missed. It's just gone to the wrong payables account. So it's gone to the wrong supplier, effectively. Now, because the amount is correct and we've got nothing on there to suggest that it's gone on the wrong side, this wouldn't actually cause a disparity between your payables ledger control account and your individual payables account, because it's not increasing or decreasing one of the balances too much or too little. So it would have no effect. Now, this is a great example, circling back to what I said before. It doesn't mean that your accounts are absolutely spot on, because obviously that does need correcting for. However, it wouldn't have an effect on the overall balance. So for this particular question, it would be no effect. The next statement then, a credit note for discounts received of £12, including VAT, has been entered into the individual payables account, but has been left off the payables ledger control account completely. So this will definitely have an effect between the two, because it means that our payables ledger control account hasn't been adjusted for this particular transaction, this credit note of £12. Now think about, where does discounts received go on your payables ledger control? Well, it decreases the balance. It reduces the amount that are owed to our suppliers. Remember that the payables ledger control account is a liability. So to reduce a liability and to put that transaction in, we would need to debit the payables ledger control account for the amount of £12. Statement number 3 then, an invoice for £60, including VAT, has been posted to the wrong side of J. Smith's account in the payables ledger. So again, this would definitely affect the balances between the two. So firstly, think about how that should have gone into the account. So an invoice would go into an individual payables account, so a supplier account, as a credit, because it's increasing the amount that is owed to that particular supplier. However, this states that it's been posted to the wrong side. So rather than going in on the credit side, it's been posted in on the debit side. So to correct that, what we'll have to do is double the amount up, because it's gone on the wrong side. It's not that it's just not been posted. It's actually gone in as £60 on the debit side, and we need it to be £60 on the credit side. So it's doubled the effect of the issue. So what we would need to do is double that £60, which would give us 120, and that would need to be posted in on the individual's payables account. So the last transaction, the total column in the purchaser's daybook has been overcast by £100. Now the balance on your purchaser's daybook would get transferred to your payables ledger control account. So if the total column has been overcast by £100, you would have entered in the total amount within the payables ledger control account, £100 too high. Now, in terms of where that goes on the payables ledger control, that posting to the credit side. It's the invoices that we owe to our suppliers. Therefore, the effect of this, if it's been overcast by £100, is that we've credited our payables ledger control account by £100 too much. Therefore, to correct that, we would have to debit the payables ledger control account for £100. Now, they aren't the easiest of questions, those, I must admit. However, what I would suggest is really concentrating on how does each transaction affect the account in terms of what should have happened, what has happened, and then how do we correct it. If you follow that process, it should see you through. But I do admit they are quite tricky. It will take some practice. It's not something you're just going to get immediately. So please don't panic if you think, I'm really struggling on this one. Just keep going with it. Try and understand the effect of each transaction and you should be in an okay position. Right, okay, moving down. The ledger columns of the extended trial balance have been produced for the year ended the 31st of March 2018. The debit columns total 2,673,865 and the credit columns total 2,674,365. And because of that, a suspense account was set up. So if we've ever got a difference between our trial balance columns, it will automatically create a suspense account so that they do balance. Part C then. Correct the following errors by entering adjustments in the extended trial balance, and this is worth 8 marks. So the first one on the list, a bank payment for rent for £4,800 has been reversed in the ledgers. So let's think about what should have happened. So if it's a bank payment for rent, it should have been entered in as a debit to the rent account and a credit to your bank account. If it's been reversed, what's happened is then they've credited the rent account and they've debited the bank account. So in order to correct that, we're going to have to double the amount and that will be our adjustment. So the first 4,800 would effectively reset the position. It would bring you back to zero. Then the further 4,800 would put the transaction in as it should have been originally. So what we want to do is double our 4,800, which would give us 9,600. And then that wants to be a debit to your rent account and a credit to your bank. So let's go to rent, and that wants to be 9,600. And then in your bank, we want to credit it for 9,600. So that would have now corrected that error. Error number 2, it says the total column in the sales daybook has been overcast by £1,000. So think about where that would have gone to. So the total column in your sales daybook gets transferred to your trade receivables account, your sales ledger control as it used to be, which shows the total amount that customers owe to the business. So it's an asset. Now, if that's been overcast by £1,000, what we're saying is you've put £1,000 too much into our trade receivables account. So therefore, to correct that, we want to credit our trade receivables. Okay, however, really important this, we can't have a single transaction. We can't only credit something, we need to debit something. Rules of double entry, we always have to have matching debits or credits. Now, because there's nothing else being affected within our trial balance, what would have happened is this would have actually gone to our suspense account. So what we need to do is debit the suspense for £1,000. Okay, remember, if it only affects one account, the other account that it will go to is the suspense account. So error number 3, Max took £1,500 out of the bank as drawings. This was recorded in the cash book, but not in the drawings account. So again, you can see here, we've got a single entry transaction. So I guarantee this will affect the suspense account. So it's been recorded in the cash book, but not in drawings. Well, the double entry to record drawings is to debit the drawings account and credit the cash book or the bank. So what's happened is that's gone into the cash book, but we've not debited our drawings. So what we would need to do is debit our drawings for 1,500. And because it's a single entry transaction, the other account that it would affect is our suspense. So we enter that in as a credit to our suspense account. Now, just to say at this point, we can see that we have successfully cleared our suspense account because it had a balance of 500 on. We've debited it for 1,000 and we've credited it for 1,500, which means that the balance would now be 0 because the debits match up with the credits. Okay, so let's make sure this last one doesn't affect the suspense, because if not, we've done something wrong. So let's have a look at it. So no entry has been made with regards to closing inventory. So when we're entering closing inventory, it goes to two places. It goes to both our statement of financial position as an asset, and it goes to our statement of profit or loss as a cost of sale, or reduction to a cost of sale, should I say. So it would be, as it's an asset in the statement of financial position, it would go as a debit. So let's enter that in. And then it would go as a credit to our profit or loss. Okay, reason it's a reduction to your cost of sales is because we've not actually sold it yet. Closing inventory, it's inventory we have. We can't class that as a cost of sale. How can it be a cost of sale if we haven't sold it yet? So it would be a reduction to your cost of sales until it's actually been sold, and then it would be recorded as a cost. Excellent. Right. Okay. And we can see that all our columns balance, which is great. So that means we can move on. So the last part of this task then, it says you have now been asked to complete the trial balance as at the 31st of March 2019, an extract of which is shown below. Important that extract, okay, so it doesn't necessarily have to balance. It doesn't mean that the debits and credits need to match up completely at the bottom because it's not a full extended trial balance. Right, with that in mind, let's go through each one. Accrued income for the year has been recorded as £1,000. The allowance for doubtful debts figure has increased by £100. As at the 31st of March 2019, it stands at £1,800. Right, excellent. Okay, so accrued income. Accrued income is classed as an asset. It is money that we are owed that we've not yet invoiced for. Okay, so it would be a debit, as it's an asset, of £1,000. It can often happen when you're partway through a project that you've done some work for somebody, but it's not yet been invoiced. We still need to record it as income because it is money that we are owed. It's money that we've done work for, and therefore that money is legally owed to us. Allowance for doubtful debt. It says that the doubtful debt has increased by £100 and it now stands at £1,800. So what we would do, the allowance for doubtful debt, remember, is always a credit balance because it offsets against our trade receivables to give the net receivables, i.e. a more realistic figure for what we're owed by our customers. So it would be a credit of £1,800. But it says that the balance has increased by 100. That is, by the way, included within the 1,800. So to record that, the entries would have been to credit the allowance for doubtful debt and debit the allowance for doubtful debt adjustment. So it would be £100 in our increase. Next on the list then, due to a large purchase of a non-current asset last month, we are now owed £540 in respect of VAT. So let's just take care of that bit before we look at the second part. So if we're owed VAT, it's an asset. So it would be a debit. So we can enter in £540 to our VAT. And then it says during the year there has been a disposal of a non-current asset which resulted in a gain of £250. So when we have a gain on a non-current asset, it goes as a credit. It's classed as other income within our profit or loss. So it would be a credit for £250. Enter that in. And then the last transaction, it says we have also given prompt payment discounts of £1,820 during the year. So discounts allowed, because it's discounts we've given our particular customers, are classed as an expense. It costs the business money because we're giving somebody else a discount. So as it's an expense, it would go as a debit. So let's enter that in. And that would conclude task number 3. So that is also part 1 of this mock walkthrough finished. I hope you've enjoyed part 1, and I hope you found, well, enjoyed might be a stretch actually, but I hope you found it useful at least. Join me in part 2 where we'll go through tasks 4 through to 6. And remember, if you have found it useful, I'd really appreciate it if you liked the video, and I will catch you in part 2.